In this video lecture, we're going to cover Unit 1.3. We're going to discuss the major players of the market. These are the references. And this is the capital allocation process. On the one side, you have lenders, and on the other side, you have borrowers. Lenders are people who have extra cash. So they are ready to lend that money. They can be individuals or they can be companies. And on the other side, you have borrowers who require money. And in order to get this amount, they are ready to pay interest on it or ready to pay profit on it or anything. So these can be individuals, companies, governments, and public corporations. Now, how are the lenders and borrowers going to interact? These people have extra money, which they want to lend, whereas these people require money. So how are both of them going to interact? For that purposes, you have financial intermediaries. Financial intermediaries can include banks, asset management companies, real estate agents, and many more type of companies that may be mutual funds, exchange traded funds, and so on. These financial intermediaries will bring the lenders and the borrowers in the financial markets to make that trade happen. So if the borrowers want to get money by selling stock in the market, they will go for the stock exchange. If they want very short-term loans, then they would go for the money market. If they want long-term bonds, then they will go for the bond market and so on. So the financial markets is where the trading will take place, and the financial intermediaries are the facilitators who make this trading possible. Now, moving ahead, the major participants for a treasury transaction is, of course, the corporate treasury department itself, then the commercial banks and the non-banking financial institutes. We will discuss the financial institutes later on as well. Then you have the State Bank of Pakistan, because the decisions taken by the State Bank will have an impact on your treasury decisions as well. Then you have the Security and Exchange Commission. So Security and Exchange Commission is your regulatory body. They're going to oversee everything and you need to follow their rules and regulation. Then you have the exchanges. Like we already said, that the markets are very important where the trading will take place. So the exchanges will serve that purpose. So you have the stock market exchange, you have the commodity exchange, and then you have brokers. Now, brokers are the middlemen who will make that trading possible. We will discuss this later on as well. What is the role of commercial banks? The commercial banks like your Standard Chartered Bank, Bank of Fala, JS Bank, Habib Bank, these are all commercial banks, and these are called the department stores of finance because they actually serve a variety of savers and borrowers. So retail investors go over there, and even your corporate business, they have accounts over there. Commercial banks, they provide deposit service. So if you want, you can go to a bank and deposit your money over there. They offer loan services, they lend money, they process your payments, they issue bank drafts and check, and they even offer safety deposit boxes for items and documents. And there are many more services that commercial banks can offer. Then you have the central bank. Now the central bank is in Pakistan, the State Bank of Pakistan, and they oversee the monetary policy, the foreign exchange management. They also try to maintain financial stability. They print currency, and they are also the lender of last resort. Basically, they oversee all other banks. All of the policies are given by the central bank, by the State Bank of Pakistan, and the other banks need to follow that. Me and you, we cannot go and deposit our money in the State Bank of Pakistan. We can deposit our money in commercial banks. So the State Bank of Pakistan is not For us, it is a bank for other banks. That's why it is the lender of last resort, which means that in case if a bank has any kind of problem or goes into financial distress, they can actually go to the central bank and ask them to help them out in that situation. We will also discuss the role of central bank in the coming units, so I'm not going to focus too much on it over here. Then you have a broker. So a broker is a person who is going to act as an agent or go between, bringing together principals who wish to deal. Basically, they're going to bring the borrowers and the lenders together in one market so that they can trade at a mutually agreed price. But they personally will not participate in that transaction. Their task is to provide good and accurate information to facilitate the fast execution of trade, to maintain confidentiality. Up-to-date indicative interest rate and prices and foreign exchange rates should be communicated by the broker, and basically they are neutral in the market. So they are just the middlemen who are bringing the borrowers and lenders so that the trading can take place. So if you want to invest in the stock market, you will have to first contact a broker and they will facilitate you in the process. Now, what are the different type of financial institutions? So we have already discussed commercial banks. The other institutes are investment banks. Now, investment banks, they traditionally help companies raise capitals. So it's an organization that underwrites and distributes new investment securities, and it helps businesses obtain financing. So if you have a corporation and you want to issue new shares, you will have to contact an investment bank for that purpose. Then you have pension funds. So pension funds, as the name suggests, they provide pension services. They will take fees, monthly fees, or quarterly fees, and in return, once you retire, they're going to give you pension. Then you have life insurance companies, which take savings in the form of annual premiums, invest these funds in stock, bond, real estate, mortgages, and then give payment back to the beneficiaries of the insured parties. Then you have mutual funds. So mutual funds are corporations that accept money from savers and then use these funds to buy stocks, long-term bonds, or short-term debt instruments issued by businesses or government units. Basically, these organizations pool funds and thus reduce the risk of diversification. Then you have exchange-traded funds. Exchange-traded funds are actually very similar to your mutual funds and are often operated by your mutual fund companies, but ETFs buy a portfolio of stocks of a certain type. So they are more specialized. For example, they might buy only shares of media companies or of Chinese companies. Then you have hedge funds. Now, hedge funds are also very similar to mutual funds because they're also going to accept money from savers and then use that funds to buy various securities. But there are some important differences. So while mutual funds are registered and regulated by the Securities and Exchange Commission, hedge funds will be largely unregulated. This is because your mutual funds, they deal with small investors, whereas hedge funds, they typically deal with large minimum investments and are marketed primarily to institutions and individuals who have a lot of net worth. Then you have private equity companies. Now, private equity companies are organizations that operate much like hedge funds, but rather than buying some of the stock of a firm, private equity players buy and then manage the entire firm themselves. So now we're going to discuss what is ALCO. ALCO stands for Asset Liability Committee. It is a supervisory group that coordinates the management of assets and liabilities with the goal of earning adequate returns. For here, we have listed some of the specific responsibilities. They are responsible for risk management, market risk oversight, regulatory operating risk oversight, liquidity, and funding management. Now, by looking at this list, you can see that these are very similar to the responsibilities of your Treasury Department. So ALCO is not going to do the management. The management is still going to be done by the Treasury Department, but they are going to supervise this management, and that is why it is very important for you to understand the role of ALCO in financial institutes. Basically, this is going to be a committee of around 6 to 7 people who are going to keep a check on the assets and liabilities, whether there is any mismatch between them, and they're also going to see if there is any pitfall that should be catered to. For that, they're going to use some benchmark performance indicators, and they're going to meet at least twice a week to discuss the strategies of the business. So their job is not to actually do the management. Their task is to supervise the Treasury Department and help them make better decisions.